Welcome to TradeTheMBI.com. This is John. This report is for the 20th of July. Well, we saw pretty much soft action throughout the day yesterday. There were some hits coming back in. But all we were talking about originally from looking at this setup anyway was that we were likely to come back to test the ABM yellow, which pretty much all we've done. We haven't even got back to anywhere near these positive extremes. That would take price, well, geez, all the way down to the 27 range here, and we're already at 28. So that would be a significant pullback if it takes place. It's just not materializing. I mean, shorts have had the preeminent move going through here. They just had to fight rising shakeout throughout all of that bearish strength, and that was what we talked about, that those shorts would be the cover for rising markets, because that's what elevates things when the shorts have to cover. Really haven't been that strong an impetus from buyers, but now you've got steel is reset, green is reset, red slightly lower here. So turnaround makes it very easy for a new upside run. Yes, we still have rising orange, but the reality is we've been rising through all this, and that should have presented more weakness than it has. So unless we get some sudden meltdown, everything's pretty much in line. And this is the problem with the idea that the world is ending the Chicken Little story, where you have to have fundamental reasons to be really bearish the market. Just the fact that it's gone up a lot is not a reason. And you can't just necessarily project that onto the market. You actually have to have some negative impetus that's propelling things to move more dramatically than normal correction, and that would be somewhere below the ABM yellow, or, well, in this case, below the 76% Morganacci lines here that we're looking at. And from the NQ, pretty much similar. Actually, it's been behaving better. It's had a much worse shakeout reading. DOC's been relatively the same, and yet it's held up remarkably the same way. Now we go back to our euro. This is, as long as it stays slightly above this zone, it's still bullish for the market in general, because a lot of S&P companies, achieve European earnings, and so that elevated euro relative to what the euro is producing, it is still elevated. There's no question about that. And of course, treasuries. This is an interesting one. It's a suggestion that, some people believe that the economy is just going to come to a stop at that, but also we're still seeing significant upside pressures from an inflationary standpoint, and it'll be interesting to see when that actually has its reckoning. Obviously, it's not being reflected, because a lot of it first shows up with, obviously oil prices, and then food prices, which they don't count really for the general inflationary numbers. So the real question has always been wages and seeing that increasing. It hasn't happened yet, meaning there was still plenty of slack in labor supply. Of course, you're hearing about shortages of labor and this and that in certain fields, but that's always the case in the growing economy. When that changes, then you have a clearer idea that things have turned in a different direction, but we're not seeing that at this point. And gold, again, still below the red line. Yes, we've got an improved DOC at this particular point, but it's still heading lower, and it hasn't begun to even stabilize. And so this is well within the expectation of what the readings are giving us. If it begins to turn around here, it could be interesting, but the reality is likely you're just going to get a move back up to this resistance point here, or maybe even a resistance at the low before the breakdown. And it's typically how that works, until there's some dramatic change. What was important about all this was that we had these positive extremes marked, and we kept putting the lines in there. And so from the couple of days of this major blowout upside move, did they fill all back in? Absolutely. Made new lows in the pre-market, which, if we shrink the chart even more, take us back to even further ones. But the reality is we'd already dipped below these before the big run-up. The key is that all of them from this big push-up have been filled within the expectation. No real shock with any of that. So we can see the day started with that downside move. After reaching the highs, we literally just broke down shakeout wise, came all the way to the zero line, and then we could tell that we had a little pop coming back, but it couldn't get above zero. And that's always a death knell when you see that happen before, right there at the 50% line. Just gets to it, can't quite get over it, and then your shakeout turns, and sure enough, it made new lows. And then it was even worse for it because white candle came in, so we knew this was coming back to be retraced. And in this case, got above the 38%. I usually like to short at those particular points when they start to come back down at that level. Held up a little bit right in there, but then filled it right back into where that close point was for the white, and then we ended up with another set of white candles, and we started popping, and it was right around the 50% where I was mentioning, okay, now it's time to be thinking about looking for that point to enter. In this particular case for me, it's that spread right here when you end up with the snake opening, which is the orange rising, steel falling, and the cyan right in the mouth of it. It was just above the short algo here, and below the 61%, but above the 50. So I thought I was getting pretty decent premium, looking for that return all the way back down to that white candle closed area, and we actually went below it, which was fine. So met the expectation within that targeting criteria. We did make another wave back, which is just showing that there's plenty of support within this. And then in pre-market, we started to get overbought immediately, and boom, they just drove it back down, filled in all the remainder of the positive extremes with ease, and then of course bounces right back up. We're right at the zero, just slightly positive shakeout at the 50. That's a danger zone. I think we could probably be coming back down at least a 50% retrace of this move. Would be typical. Nothing as far as an oversold in any of these. Even in this dip, the extreme stayed above the negative 60 line, which means that it was just pretty much a liquidity drain. It wasn't really any massive amount of dumping per se. So all in all, market's behaving very nicely for early summer. So I don't think there's anything to get excited about other than just playing the normal volatility. I mean, we're still seeing some decent numbers. Every time we squeeze into this 10 or so, we expand back out into the 20s, 25 range. That's all perfect stuff. So we'll take advantage of it as it warrants. And I'll certainly put up charts like I did the other day, and we'll take it from there. As always, trade well.